Alrighty. Good afternoon. Today we're going to cover something I think a lot of people are interested in. So a lot of people ask consistently, all right, consistently, what is a market maker? I know you're probably expecting me to go over charts. I can do that real briefly, right? But I think a market maker and knowing a market maker and their mentality and stuff like that, I think that's very important to a lot of people because they want to understand the purpose and the reasoning behind trades. Um, so kind of starting off, Bitcoin's still in the bear flag. I'm expecting price to come up and kind of retouch these tops, probably come back down, wick, and hold this volume below, which will be kind of bearish for the probably midterm of the current micro scenario, right? So maybe like days, weeks, so on and so forth. We could see a retracement all the way back down to these lows. That would then retest our old OB here, like we've talked about in the past, this yellow candle right here. We would then kind of come back and retest that, probably play high if we do that. And then with that retest, we could see liquidity move to the upside, right? So that's my expectations right now. So again, we could see a wick for a couple of days. Price will move back. My expectations for in a month will probably make a big move, right? So from where we've built structure from, we need a big move down or a big move up, right? So when I say big move down, big move up, it doesn't mean like Bitcoin pulls back to here and that's the big move down. No, that's not the big move down. So expectations are a couple different things here. So if we were to just remove all the stuff I have here, we can get rid of all the bear flags and everything else that's going on currently, and we'll just look at the structure. Again, we're still moving into a build long, right? A build long, right? A build long, right? And these are higher lows, right? A build long, a build long, and that's the structure right now. So this is the structure we're currently building in. We can break this structure and come down and still kind of rebound. I'm looking for a big move, right? So a big move means like, for instance, price maybe jumps up, comes back down, you get the wicks, you get the bodies right about here. So price then falls back to here and then comes all the way up and retests the higher end here, right? So if price were to do that, I would expect a reversal in this direction. And that would probably break structure, right? That would be my expectations because this would then, and I'm going to show you this because I think a lot of people don't understand this. This would then form an M, right? Because this formation would go like this. We'd probably get a bounce to here, a move back up to the high, maybe a little bit lower, right? And then we would go deeper. So that for me would formulate an M. Now, what would formulate a W, right? Which could bring us up higher than where we are right now. Well, if we were to go to a W, I would expect price to fall in somewhat in the zone we're currently at, but price could probably peak to right about here, right? About midway back to here into a double bottom, right? Now, does the double bottom have to come back and recapture the entire wick? No, maybe it comes with right there. Into a double bottom, and then I would expect price to go higher than the current move. Now, both of these scenarios are somewhat bearish for me because for me, the structure of the W would then kind of come back down and really bad, right? So we could see this W reverse into an M. So then we could see price move down, move up, and then move back down deeper. So this could be a bigger play on the micro. Right? Sorry about that. We could see a bigger play on the micro, into like a more macro scenario that could play out months. The other scenario I would look for is if we get this information, we could then kind of see that retracement into a big W, right? So you got the move, and the move. And then that kind of breaks out to the upside. And then some people are like, oh, there's a W. Now, either way we look at this, I think long-term, not long-term, we'll say like short to mid-term, we're going to be bearish for a little while. Lots of economic issues, potential wars going off in other countries that could be happening. Don't ignore the whole China thing where they're kind of talking about the whole, being upset about the U.S. going over there to Taiwan and stuff. So just throwing that out there. Not trying to get anybody like scared or anything like that. I just these are market mover scenarios that could happen, aka black swan events that could happen. So don't ignore those. Housing showing weakness right now. A lot of sectors are actually showing weakness, and the markets are still rallying. That's not a positive thing. I know a lot of people think it is, but once these different asset classes start seeing the money hit their books and they start seeing that that pullback in revenue and they're not able to gain that revenue anymore, those companies will then start laying off, and those people that are investing will then start pulling their money because they'll need that money because they'll be laid off. So be very careful in the markets. That's kind of my market update right now, kind of with BTC. I'm not going to go through all the charts like I normally do. ETH kind of in a similar situation. I'm looking for ETH to kind of break up to this midpoint. Oh, and over here real quick before we move on, just so you know, like when I say the 50% yada yada, so if you draw like a fib from the high to the low of the current move, right? Expectations would be that price remains or comes back down, retraces this 0.76, right? 0.786. So the 6.5 and the 786 are kind of that institutional discount zone. You can look this up for yourself. It's the atypical, the 618 and 0.65 are your golden pocket zones. So I would expect price to come back down to the red zone, you know, the 0.76, 0.786, which would be your 20K zone, right? Price will revisit the 20K if it's going to turn into a W. And then from that 20K, we then see price kind of reversal. But right now, or we see the opposite, right? We see price break through that 50% zone. Price come up and hit this 0.25, maybe a little bit higher. Come back down to this golden pocket, right? 0.65. People calling for upside, and that turns into an M, right? So be very careful listening to people who aren't understanding structure. I'm not trying to bash anybody who, you know, may discuss TA in a manner that they know, and they're like, oh, well, you know, the this and that means this. I can tell you, if I'm looking at indicators are hugely lagging. You see the indicators way behind. We're above the 50. I would take this as bullish, which means price will probably continue, which means if price continues, I'm expecting that M formation to kind of form out here. Price is kind of dying down. See volume right here. So if I were to look at this from a, what's it called? What's the one that a couple different traders use? This is called Fu Manchu as far as indicators go. So this kind of indicates direction of price. You can see right here that price from red to red is decreasing, or not price, but volume is decreasing. So you got volume decreasing, whereas over here, you got the indication that volume was what? It was increasing. So you got the green dot. So that's telling you price is going up, and then price moves above the zone. And that's where you get the big moves. And now we're starting to see that decrease. We got the green buy here, but that could just be another decrease. And then we could see volume fall under. You got the red money wave right here, right? And green money wave. Green money wave means money moving in. Red money wave means money moving out. Money's been moving out the whole time that we've been climbing here. So we're getting that selling pressure starting to step in huge. We got the big red dot here. Again, I don't want to use indicators because I don't like people who be like, oh, this indicator says this, so this is going to happen. Indicators don't tell you anything, all right? They can give you a clue. They can verify your information, but you should be looking at chart patterns to identify your information, not indicators. You can use indicators, like I said, in stochastic saying oversold if I'm looking at indicators. But at the end of the day, nothing will tell you better on what is currently going on in the market and structure than price action. Higher highs, higher lows, market building in a direction, so on and so forth, flags and everything else. My next video is going to be based around flags. I want you guys to understand chart patterns. Patterns are a thing. Patterns will tell you direction. Patterns are everything. But me saying, hey, there'll be an M or there'll be a W, these are just me coming up with different theses, right? And that way, if price gets to here, I'm like, okay, I'm looking for the M. If price gets to here, right, and falls back right now, okay, I'm looking for the W. Because why? Because that would be the pattern. That would be the pattern if we're looking for a W. We would look for price to rest in a specific position, reject in a specific position under the 0.5, pull back from the 0.5 all the way back, right? We could see support in this zone, the 20K, and it would just be a long building W, right? So we got a long building W, and then we would see price reversal. A long building W is even more bearish in my opinion, because it tends to come back, right? You got the upside. Don't get me wrong. You got the upside of the long building W. So you got the W, move into the 50, pull back to here. You got the uptrend. Everybody looks for lower. Price comes back up. Price hits the top, and then everybody's looking for breakout. And then price comes back down, right? And does price come all the way down here immediately? No. It then forms into an M, right? And then price comes back maybe to the 50, and then bounces back up, maybe a little bit higher than the previous. That would then move into what we call an ABC. This is a lot of information I'm feeding you guys right now, okay? And I'll break this down more and more as we go on to weeks and videos. price would then break into what we call an ABC. So you got the 0 into the A, into the B, and then you get the ABC formation, the higher high right here, confirmation. Everybody gets super bullish, right? They're like, oh, it's breaking out, it's breaking out. And they come all the way up to maybe 32, right? And then from that 32, we didn't see price what? Just straight tank. And again, it doesn't have to be a straight down move. It could be a correction wave before it actually tanks. So this ABC turns into, a different ABC. So we get the drop down, the bounce, and then the move. If you look at this is what we call Elliott wave structure. You guys can look up these different items. We can even call it Wyckoff, whatever you want to call it. I don't go looking at Wyckoff. It's literally a tunnel of just bad. Look, it will confuse you if you don't understand TA. Wyckoff will confuse you. Don't listen to somebody who says Wyckoff if you don't know Wyckoff. All right, because somebody that claims Wyckoff may not even know Wyckoff. They're just using Wyckoff because they don't know TA. Like if they can tell you directively, like, hey, these are kind of your options on market direction. So we could be looking for the down into the up, into the down into the up. That's directively me telling you, hey, when these moves play out, if we reject here, that we're coming back to here. And if we push back up again and we start breaking back out and we get above this middle zone, price is going to come back up to finish out the W, right? Just like, and I say, I say this specifically, but in reality, price could reject a little lower, it could reject a little higher, it could reject, wherever. We could have the black swan event in the middle of the move and then the move starts to pull back. That's why we don't predict and say, hey, this is what's going to happen. I give you the options of what can happen. We look for the move, we follow the move, and then as the move's filling out, we're like, okay, that worked out. Or we're like, okay, let's kind of restructure it where it sits, right? Because sometimes the move goes off and it just keeps on just veering up like it is right now. Maybe it just keeps doing what it's doing, just building. But again, these kind of patterns are bad in my eyes, and I'll discuss patterns later. It's very easy to tell, when we're building long structurally, right? It's a bad sign. You want to build short. That's what you want to do because you got to shake people out. If you're building long, this is not the way to do it. Look, if you're building long to move a market, this is the way to do it. But gradual growth. See that? That's growth. This is growth. That's growth. This is a retracement. That's growth. This is a retracement. That's growth. This is a retracement, growth. And now we're moving into what? No growth, right? Growth going negative. Hey, scared. Retrace. Move, growth, retrace, growth. Now we're moving into people actually exiting the market. This is no longer growth, right? This is reaction, emotions, rejection. Reactions, emotion, rejection. Reactions, emotions, rejection. That's what I expect for any type of build long, right? Build longs are basically just retracements. See how this move down and this move down and this move down look like this move up and this move up and this move up, just the opposites. This is why you have to pay attention to what type of market you're in. Don't get lost. All right, as Nick Choi in our group, the coach likes to say, don't get lost in the sauce. Because why? Because the market will wreck you. Okay, it will wreck you. Again, so just thoughts, ideas, throwing them out there. I want people to pay attention to the structure that's actually building here. I want people to understand the structure that's building here. And I know a lot of people would be like, this and that. And here's the thing. Everybody learns in their own way. Don't follow specifically what I say. Don't follow specifically what somebody else says. Take what I say and just use it as a tool to make your own analysis, a tool to make your own decisions. Okay. That's basically how this should be built. That's how structure should work. It should work off this guy is always right, or that guy is always right, or so on and so forth. Take what I say, go look at, some other guy, you can go Frankie Candles, BitBoy, you can go, let me think here. There's quite a few different TA guys. I know there's another guy called the Bullish something. Let's see here. I know I named out the big one, sorry guys. TA guys. You can go off Rand and his guy, the TA guy. You can even go off MM Crypto, even though I've barely ever seen him show a chart that's not on a cell phone. I think it's a horrible way to do charting. There's tons of guys out there that you guys can follow for TA. I would just say, just don't take perma bulls as your say all be all, guys. Okay. I think there's another guy out there, Data Dash or something like that. If they're perma bulls, it's a problem, right? If they're perma bears, it's a problem. You don't want either one of those guys in your court, but you can listen to them. Just don't let them convince you, right? The only convincing that should take place is you convincing yourself. You can take my information, you can apply my information, but at the end of the day, you're the one who pulls the trigger on your money. So you need to be the one to make the decision on market direction, but you need to understand direction first and structure. So we're going to kind of cover that a little bit, but today we're going to cover market makers. I want people to understand market makers, and I was going to do a video on, I wanted to do a video on shapes and wedges and all stuff like that, but I really think that people should start with market makers because we have to understand the ideology, we have to understand the move, we have to understand the purpose of the market maker and why liquidity is the way it is. Market makers just keep money moving. That's it. All right, let's discuss it. All right, let's move into market maker. So again, I go to Investopedia a lot to kind of find definitions, and then I give you a simplistic breakdown of each scenario to kind of show you, hey, let's discuss what they mean by this, right? So in this article, and this was made by Andrew Blumenthal, pretty accredited guy right here, updated August 31st, 2021, reviewed, fact checked. I don't know what the fact check is. They just got to stop with that. But you can do your own research and figure out whether it's true or not. What is a market maker? All right. The term market maker refers to a firm or individual who actively quotes two-sided market, right? Because what is a two-sided market? A two-sided market is there's a buyer and there's a seller, right? And you need a buyer for every seller, and you need a seller for every buyer. Why do you need this? Why does liquidity flow in this way? Well, if I have 100,000 of a million items or whatever, right? And let's say I have 100,000, so I have 1/10 of them. Well, what happens when there's no buyers and I want to sell? Well, if I want to sell some of my 100,000 and there's no buyers, the market doesn't move down. That's just how it works, right? So the market doesn't move at all. Nobody's buying. Now, what does that mean? That means price moves completely sideways. It doesn't move up. It doesn't move down. It just stays still. It's stagnant. You never want a stagnant market. Why? Because stagnant markets do not interest buyers. You cannot interest somebody with something that is not innovating. You cannot interest or get somebody into, America's Great Pyramid Scheme, but we won't talk about it, stock markets and so on and so forth, and any asset class that you're putting money into, because there's no market movement. If there's no market movement, there's no money inflow. There's no money inflow, then there's no buyers. So that can create a problem for sellers, right? And what does that do to investing? Well, investing, that creates an issue because now people see, hey, there's times where, that market doesn't move for a year. So my money would just be just as good in my bank account as it would be in that asset. So now you're getting a problem enticing people to even come in. So now you're not only creating a problem with buying, you're creating an issue with people wanting to invest, people wanting to put their money in. So if people are not wanting to put their money in because they know that price doesn't really move, now your asset is completely useless, which is technically how every stock and everything else in the world out there should be, because it has no real intrinsic value outside of dividends, right? So if companies are paying dividends based off of their profits, that's a different discussion. We can talk about that. If they're not paying dividends, guess what? To me, I think we know the word for it, but you know what it is. All right. So now, does that mean you can't invest in it? Of course you can. I mean, look at Shiba, look at all these other, dog coins that basically got investors to put their money in based on nothing. So, and I'm not bashing, those investments. They were able to do good marketing. They were able to entice people. That's all it is at the end of the day. It's not about asset class or this or that. It's about returns. If your return is higher because you invested early, that's just how it works. All right. The term market maker refers to a firm, and this is typically why I go back to, ETH BTC, because the people that invest early are the ones that are screaming a lot as for you to get in to keep their bags pushing up. The term market makers refer to a firm or individual who actively quotes a two-sided market. in a particular security, right? So typically this is based around securities because securities are regulated, so on and so forth. And this is why typically governments see crypto as an issue when it comes to these type of scenarios, because you do get market makers even in crypto, but they cannot be regulated in crypto. And this is why manipulation in these type of markets is much easier. There's nobody telling them, hey, you can't dump your entire bag on, retail. But in stocks, there is. That's the government. The government says, hey, you can sell X amount, but you need approval to sell the rest. Otherwise, we'll stop your selling. So that's why stocks are more secure in a sense, because the government can actually regulate the selling and buying of the stock if they need to keep the fluctuation low. And what do we mean by low? This is why the stock market drops 13% and Bitcoin drops 50%. This is why the stock market drops 25% and Bitcoin drops 75%. You have to keep these things in mind when you're looking at markets, okay? And again, if I'm expecting stock markets to drop more, guess what? If they're dropping their bags in stocks and they're regulated on how much they can get rid of, right? Then in that case, you could see them dump even more in high risk assets. This is why high risk assets are based on volatility. Just FYI, that's what a high risk asset is. A lot of people like to say, "Oh, you say Bitcoin's high risk." No, it's based on volatility swings. Does price swing X amount within a day? Does price swing X amount, within X amount of time? So on and so forth. Can people see, 80% losses in a year? That's huge volatility. Now, we'll discuss that later. I just want you to understand that part. So, market makers provide what? They provide liquidity. And you're probably like, yeah, hail the market maker. They provide liquidity. They don't just provide liquidity. They take liquidity. They wash the markets in, they wash the markets out. And whoever's left standing is whoever's left standing, right? You buy high, you're stuck holding the bag until the price comes back up to that point. That means the market maker washes the market way up, and then the market maker washes the market way down, right? So if you bought all the way up here, it could take a while for the market maker to push price back to your zone and then beyond. So your profitability is significantly less. This is why you don't buy tops. This is why you don't sell your house to buy whatever asset, you know what I'm talking about, so on and so forth, all right? Because any of these things can occur. So they may also make trades for their own accounts, which are known as principal trades, okay? Key takeaways: a market maker is an individual participant or member firm of an exchange that buys and sells securities for its own account. Now, market makers provide the market with liquidity, the depth, while profiting from the difference in the bid and the ask spread. So you're probably like, what is the difference in the bid and the ask spread? Well, it means that, maybe Jake over here, we'll say, right, our retail buyer, wants to buy Tesla, right? They want to buy Tesla for $107.35. And they want to buy 1,000 shares, right? And you're probably like, well, Tesla's like $1,000. We're just go with the story. Just go with the story, right? We'll say $100. We'll just go with 100. We won't even add change. We'll just go with 100. They want to buy each stock for $100. Price gets to $100, right? Do you think their order's placed? It can be, right? It can be, but typically it's placed at 115, or it is placed at 100. But on their end, the difference in spread might be 100, and the current price they got it as technically 115. They still got the same stocks, right? Or maybe they got maybe the stock spread that they got from the market maker was $99.75, but they sold it to Jake for $100 a share. So they made a 25-cent difference on every share. So 1,000 shares, 25% difference. Well, that's a decent pump, right? Now, if you do that to 100,000 shares, hey, you've washed out quite a bit of liquidity by selling just above asking price, aka the spread, to the buyer. And vice versa for selling. They make money on both ends. So if you want to sell, right, then guess what? You're selling higher than where you want to, technically. So keep that in mind too. What does that mean? That means if price is, you're looking to sell at $100, well, the market maker, they're like, okay, we'll get you at $100, but technically they're selling you out at 125. All right, because they're getting that 25% spread. So you have to keep that in mind when you're looking at market makers, and this is how exchanges work too. This is why swaps are technically better, even though you're paying the fees. The only problem with swaps is that you can't control price. Price is more like a market taker, right? So a market taker and a market maker are two different things. A market taker is saying, I'll buy any price right now. Here's $100,000. And they throw their money in. So they bought a little bit at 100, they bought a little bit at 125, a little bit at 110, as price is rising from their liquidity pushing it. And that pushes price up. So market takers are typically what pushes prices up, right? Will the market maker be a market taker? Sure, they could be a market taker. I'm going to discuss market making in a few minutes on the charts. So let's continue forward. Market makers provide the market with liquidity and depth while profiting from the difference in the bid and the ask spread. Brokerage houses are the most common types of market makers. So this is who you need to look for if you're looking to see who market makers are. Providing purchases and sales solutions for investors. So when an investor wants out, these guys are like, sure, I'll pick up your bag. I'm gonna take that for a little bit less than what you're offering though, right? I'm gonna make some profit off of whatever you're asking me to buy at a premium, because basically the market maker at times it's buying at a premium, selling at a premium, and I'll show you how they equalize that. All right, market makers are compensated for the risk of holding assets because the security's value may decline between its purchase and its sale to another buyer. So its purchase value may decline between its purchase and sale to another buyer. And this is how they balance markets, and I'm gonna show you guys that on a chart. While brokers compete against one another, specialists post bids and asks and ensure they are reported accurately, right? So accurately on the blockchain, this is much easier to visualize because you could see all this, right? They can't hide it. It can't be hidden from you. This is why blockchain is powerful. This is the one reason why I would say, even though, we talk about the one word, and I think all assets are in that one word, I think blockchain is much more transparent to the retail than it is to the actual, than it is to just one side, right? So if we think about it like that, that could be really crazy. So what does it mean? Actually, we'll get to this next. I want to keep going. So what if you had started investing years ago? You had Tesla, $1,000. We'll say you put in, I don't know, $12,500 or $500 5 years ago. This would be your profit right now in Tesla. Now keep in mind, this right here, it becomes diminishing returns the higher and higher Tesla goes. So yes, you would have made this much money off of Tesla. Will you do this still? Probably not, because Tesla has so much money in it, right? This is what I like to call top heavy stocks. And they love to use this as an example, like Apple, for instance, right? Look at Apple's, because Apple is compounded so hard. Look at Nike, because Nike is compounded so hard. Amazon, because Amazon, it's not that these companies haven't got a similar performance. They're pretty close, I'd say. All these, and this is why they're using them as specifics, right? It's just that performance to growth, right, can only happen so much. And then once that growth has kind of reached what I would call a peak, it's now compounding. It's now less value, right? It's kind of like what we talk about, with Bitcoin, the S&P, and so on and so forth. There's less value in them because they're not starters. They're not movers. Now, does this mean get into a speculative project or a speculative stock? No, it doesn't mean enter into one of those. But I think mid caps are a great start, right? And we can discuss mid caps moving forward. But I think that's the key to looking for a great mover. You want something that's kind of establishing itself. Don't be like, oh, well, this is the future, so I'm gonna buy this one that just came out because they said they'll do this, and that. No, let something develop, right? Something move into that mid-range. And then once they can show that innovation where it looks like it's starting to come out, hey, you're in a good position, right? You're in a good position. I think mid caps are the key that a lot of people are ignoring, and they're looking at small caps expecting ridiculous returns. All right. Many market makers are often brokerage houses that provide trading services for investors in an effort to keep financial markets liquid. Okay, by keeping financial markets liquid, it means they'll buy when you want to sell. It means they'll sell when you want to buy. Do you understand that? Like that's how the two side works. You think you're selling just to retail. No. Market makers are typically the ones picking up the bags on both ends, right? They will help push price up if price wants to climb. They will help push price down if price wants to decline. They are the ones that initiate the moves, typically, as well as initiate the supports and the resistances. When they know there is no interest higher, they will not go higher. When they know there is no interest lower, they will not go lower. It works on both ends due to the size of the securities needed to facilitate the volume of purchases and sales. The vast majority of market makers work on behalf of large institutions. Now keep in mind, they only provide and they only commit so much liquidity. And then once they see liquidity won't go any higher, aka moving long to go short, they typically will then start sweeping liquidity out at the highs. And then that means basically price isn't really climbing. There's buyers aren't really stepping in anymore. And now they have to start selling onto retail, right? And then retail continues to sell that push down. And then that push down ends up usually dropping below the floor. And that's what causes bear markets. Each market maker displays buys and sell quotations for a guaranteed number of shares. Again, each market maker displays buy and sell quotations, which means they're holding both ends of the market for a guaranteed, all right, guaranteed number of shares. So this means that, again, they guaranteed X amount of Bitcoin to this drop. Once price dropped to a certain zone, they no longer guaranteed any more Bitcoin to this drop, right? And then you're probably like, what do you mean Bitcoin? I mean cash, sorry. So they guaranteed X amount of cash to buy in Bitcoin to this point, right? And it may have been they guaranteed buying to this point, and then price continued to push through, and retail, continued to oversell, and and other market makers stepped in and guaranteed X amount of price. So maybe part of market maker here, part of a market maker here, part of a market maker here, and part of a market maker here guaranteed price. No more would they guarantee price any lower, right? Now, what does this do? Well, every market maker here is in the red. So they're in the red because they bought down all the way. They hit the lows, and now they're in the red. Now the market makers that bought down here, they're in the green, right? So maybe there's 3 market makers in here. So 3 institutions, so on and so forth. Now they have to build price back up, right? These institutions have to work together to build price back up so they can rebalance the move. So now they're going to build price back up. And then once price gets back up, to equalize the loss that they took on the drop, right? Once they equalize the loss that they took on the drop, guess what? Unless buyers are stepping in to push price beyond this, aka retail, market makers feel there is no interest at this price, right? So if they feel there's no interest at this price, they're then going to reject on this price and come back down. Now, what happens if they get back down to these lows? Well, because they committed liquidity here, right, to these drops, this drop was never rebalanced, which is very interesting. Very, very interesting. I mean, we could say it was kind of rebalanced over here, so it kind of fell through, right? So this price kind of fell over to here. And we could say the same thing about this. Like, we could say that, maybe price comes up to like right here. And that's kind of the move there. You can see right there, look, if you look at the drop in the yellow, they pretty much even out, right? You look at the drop in the yellow, they pretty much even out. So you have to be careful with kind of coming in and expecting price. So that means that price could technically just move up to this 26.5 or 26.6 and then reject from there, right? And what does that mean for the move? Well, if we're equalizing the overall move, right? Then I would look at the same kind of move as what we saw over here. And that would definitely push us deeper if we were to look at it from that kind of point. So if I were to do a bars pattern, and let's say we go over here. I didn't mean to grab all that. Let's get rid of that. We'll go from here. So we'll say that, maybe this occurred or whatever, price shot up. And you can see the drop right here. That would put Bitcoin down in that 15K zone if they were to do it again. And that means they would commit the same amount of liquidity they did here to here, right? That's the thing we got to understand. Are they going to commit the same liquidity? So if they commit the same liquidity, they'll then drop down to here. Now, it depends on how much liquidity they want to commit at the end of the day. So whatever liquidity it took price for them to buy down to here, they could end up committing the same liquidity here and making the same move back up. But as these moves shorten on these drops, right, we could start to see consolidation. The thing I'm looking for is for them to commit liquidity like this to the downside. When they start committing liquidity to the downside, that'll be a very important thing to kind of watch for. All right, moving back to the understanding. Many market makers are often brokerage houses. A market maker can also be an individual trader, right? So a lot of people don't realize this. They're like, what do you mean a market maker be an individual trader? Here, I will show you an example, all right? And the same thing could occur in stocks. It could be a publicly traded stock, aka Tesla, but one person owns a majority share, right? That's very important to understand. And that person that owns majority share is technically the individual market maker. They can move price as they will because they own majority. So let's go in here. Let's look at let's look at some recently added on CoinMarketCap. I think those are great examples. Let's go here. Recently added. All right. So for instance, see the liquidity / market cap of these? 2,750,000. That could be one liquidity provider. One. Right here. That is right. 2 million. Sorry. 2,750,000. 6,519,000. 308,000 could definitely be one liquidity provider. 974,000. 1 million, 10 million. This is what I'm telling you guys. Like, these guys can literally make a coin, make some BS, add 20 million to it, and then tell people to buy. And then people buy it. And then they dump, and their 20 million is now worth, 500,000 or 500 million. Then they dump all that on a retail's head, and they exit the coin. This is why you have to be really careful with a lot of cryptos, especially new cryptos, and understand that, price could be manipulated based on who owns what. The more liquidity that's committed, the less likely that can happen. So for instance, Bitcoin, 444 billion, right? $444 billion. This is harder to manipulate. Ethereum, 208 billion. Harder to manipulate, but we have to also look at Ethereum. Look at Ethereum, who has the most of it? Our little buddy Vitalik. Yeah, so be careful with Ethereum too, even if they say it's institutional. All right, these are basically stable coins. Again, this is like, imaginary money. You're giving them your money. They're printing you imaginary money. You're using that money to then buy other things. And I say imaginary, not that it doesn't hold value, because it holds value based dollar for dollar. But it's a digital dollar versus an actual currency. BNB, same thing, 52 billion. This I think could be manipulated. And everything below here is definitely could be manipulated. Look at all these 18 billion, 17 billion, 17. Think about this. All right. Consider this. Whoa, where's ADA? 17 billion. All right. ADA, top of bull run, was sitting at $90 billion market cap. 90 billion. Okay. With a B. It's now sitting at 17 billion. Big whales have already washed out. Now you got smaller whales moving out. So they're providing liquidity at lower zones, and they just keep dumping. That's all they do. They provide liquidity to build long to get them out of their position. And then once they get out of their position, then they allow price to go lower, and they rinse and repeat until they wash out the market. The market will get washed out from this. All right. Also, be an individual trader, who is commonly known as a local. Due to the size of securities needed to facilitate the volume of purchases and sales, the vast majority of market makers work on behalf of large institutions. Work on behalf of large institutions, aka institutional investors in crypto, right? It makes sense. When you're seeing liquidity get washed around like that, that's typically how these move. All right, each market maker displays buys and sell quotations for a guaranteed number of shares. So they guarantee a certain amount of shares. They guarantee they'll buy, 1,000 Bitcoin. So when you see, 1,000 Bitcoin was bought, that's because they guaranteed that. It doesn't mean price isn't dropping. It means they guaranteed they will buy 1,000 Bitcoin as Bitcoin's dropping. That means 1,000, 1,000 went out, 1,000 came back in. They bought that, right? The drop came down. Or maybe, 10,000 went out and 1,000 they bought and 1,000 another one bought, 1,000 another one bought. So the price is getting washed, essentially. And price could deviate far beyond where price started. And they could be selling, a lot of, think of it like this too. They're buying a lot more Bitcoin on the catch of the bottom of these moves than they are at the tops, right? So they're buying at market value, like what they're just guaranteeing, that they'll buy. That's pretty much it. And they're not guaranteeing a price. They're just guaranteeing, hey, we'll buy down to this position and then we'll push price back up. We'll buy down to the next one. That's typically how bear market works. Once the market maker receives an order from a buyer, they immediately sell off their position of shares from their own inventory. So once people start buying, guess who's selling to you? The market maker, right? That's what causes tops. They immediately sell out from their inventory. This allows them to complete the order. So they bought at the low, they sold at the high, and that completes the order. In short market making facilities, this allows them to complete the order. In short market making facilities, a smoother flow of financial markets by making it easier for investors to trade, to buy and sell. So this means that they will always offer you a sell and they will always offer you a buy up to a certain amount. That makes it easier for people to get out. That makes it easier for people to get in. So if you have low transaction volume, aka low TVL, then you have to be careful because you may not be able to get out of that asset, right? If you have low transaction volume, that means that market makers are not interested in your asset. They don't think it will do well. They don't think performance will do well. And when you go to sell, you may not have a buyer. Without market making, there may be insufficient transactions and fewer investment activities. This is why Bitcoin has such big market makers, because people know that Bitcoin will move. People know people will be interested in buying Bitcoin. People will be interested in selling Bitcoin. Same thing with Ethereum. It doesn't have to have any kind of value outside of that. We can argue till day and night. Ethereum got people building on it. Oh, this and that. No, it's all about liquidity. There's a ton of liquidity committed to Ethereum. There's a ton of liquidity washing in, ton of liquidity washing out, ton committed to Bitcoin, so on and so forth. It doesn't mean price won't go lower. It just means there's a ton of liquidity committed to it. All right. This allows them to complete the order. In short, market making facilitates smoother flows, yada, yada. Without market making, there may be insufficient transactions and fewer investment activities. Okay, so like we talked at the beginning, without the market maker, less people will be transacting. That means, so the markets would just only move when you got off work and I got off work without market makers. That's it. It means that if I got off in the afternoon, I go and bought a stock and then, maybe 5 years later, it went up 10%. And then, I want to sell that stock that 5 years later to get my 10% profit. And, maybe it takes me 6 months before I find a buyer, or 2 months or a month. I'm kind of over exaggerating it, but you get the point. It makes markets smoother. So you need market makers to be able to have liquidity. You need liquidity to be able to move markets. You need to move markets to be able to create investments and create interest. A market maker must commit to continuously quoting price at which it will buy or bid, okay? AKA buy or bid for. So just so you guys know, there's buy bid and sell ask for securities. So a bid and an ask always has a price difference. So they pick up that price difference on the sell, they pick up that price difference on the buy. So they're making money not only on the buy and the sell, so they're basically getting a transaction fee from you. They're also making that money by buying low and selling high, because they're the ones creating the floors. They're buying down to a certain point and they're selling down, or buying up to a certain point and then selling down to a certain point. That's it. Because they're only committing to buy X amount. They're only committing to selling X amount. So when we're in a bear market, we could typically see that go in both directions. Because some market makers will step out, right? When they see an asset is too volatile, the market maker will then step out, and other market makers may stay in to play the market to the floor. And other market makers, it could be one after another as they're trying to, capture liquidity that was lost, that they just start stepping out. Maybe it takes them 2 drops and a rise, or maybe it takes them 2 rises after a drop, and then they step out, and that causes deep drives down. Market makers must also quote the volume in which they are willing to trade along with the frequency of time they will quote at the best bid and best offer prices. Again, quote the volume in which they're willing to trade along. So if there's a certain amount of volume, they'll trade. If there's not a certain amount of volume, then they'll sit on their hands and they're not going to market make in that market. AKA what's happening with crypto right now. We're getting to those volume levels where market makers may start stepping out after they've grabbed their profit on these rises, and they may sit on their hands until volume comes back in. They'll move to another asset, right? When I say sit on their hands, it doesn't mean that they won't provide liquidity somewhere. They'll just stop providing liquidity in crypto. They'll provide it somewhere else. And that's typically what causes those stagnant scenarios at the bottom of the market that I spoke about before, where we get those months where it's literally looking like it's just running sideways and no price action. Market makers must stick to these parameters at all times during all market outlooks. When markets become erratic, or volatile, market makers must remain disciplined in order to continue facilitating smoother transactions. That means they will stop buying to a certain point, right? They're just like, hey, we're not buying anymore. So if they're not buying anymore and you're selling, guess what? No one's there to pick up your bags. That means that prices stopped moving deeper. So if they're selling and you're buying and they no longer want to sell anymore because they've sold X amount of their position, guess what? You've hit a ceiling. You bought the top. Now they're going to push price lower because they need to buy back into the market. Think about it. How market makers earn profit. Market makers are compensated for the risk of holding assets because they may see a decline in the value of a security after it has been purchased from a seller and before it's sold to a buyer. So consequently, they commonly charge the aforementioned spread on each security they cover. For example, when an investor searches for a stock using an online brokerage firm, it might observe a bid price of $100 and an ask price, exactly as we're talking about, of $100.5, which means the broker purchases the stock for $100, then sells it to the prospective buyers for $100.05. Through high volume trading, a small spread can add up to a large daily profit. So in crypto, what could we consider a market maker? I can give you a couple. Binance, Coinbase, I forget the one that starts with an F, FTX, right? When you look at these are all market makers. What do they do? Well, rather than giving you a spread price, aka they take the middle, they give you what? They give you a fee, right? The fee is their spread. That's their spread in crypto. It's the fee, the transaction fee. You buy, you pay a fee. You sell, you pay a fee. If you hold their coin, you get a cheaper fee, aka you're providing more liquidity for the platform. Think about it, right? You have to be cautious with understanding everything that's going on. There's always somebody's getting paid on both ends. All right. So incentive there is for what? At some point, it's for prices to go deeper. The reason for them to go deeper is so they can add more coin to their book. So later on, when you're bringing the liquidity, they can soak all that up at the highs. All right. So keep that in mind also. Market makers must operate under a given exchange by law, which are approved by country security regulators. Oh, sorry about that. Oh, I just went up the wrong page. Sorry about that. Which are approved by security regulators. Yeah. All right. Market makers versus specialists. Many exchanges use a system of market makers, each competing against one another. to set the best bid or offer in order to win business of orders coming in. Yada yada. All right, so specialists post these bid and ask for the entire market to ensure that they are reporting in an accurate and timely manner. So again, we don't have these in crypto, so it doesn't really matter in crypto. Example of a market maker. Here's a hypothetical example. To show how a market maker trades, let's say there's a market maker in XYZ stock. They may provide a quote of $10 to 10.05, 100x, 500x, or 100 times 500, or yeah, times 500. This means that they make a bid, they will buy for 100 shares for $10, and also offer they will sell 500 shares at 10.05. Other market participants, see how they're selling at a premium, may then lift the offer from the at 10.05 and sell to them, hit the bid at 10, right? Who are market makers and what do they do? A market maker participant or participates in the security market by providing trading securities for investors and boosting liquidity in the market. So they basically, market makers are market manipulators, right? And so when you hear the word manipulation, you have to understand the process of that. That means that they are driving the price higher, atypically, in most markets. So the manipulation is not necessarily a bad thing. The hard part is when they're trying to scare out investors to a deeper price, right? So when they try to do that, they basically lift the price up, drop the price down, lift the price up, drop the price down, aka what do we call our retraces, right? Or our dead cat bounces, relief rallies. They specifically provide bids and offers for a particular security in addition to its market size. Market makers typically work for large brokerage houses that profit off of the difference between the bid and the ask spread, or the fee that most crypto exchanges are currently charging. How do market makers work? A number of market makers operate and compete with each other within security exchanges to attract the business of investors through setting the most competitive bid and ask offers. Right here, guys, right here. This is the key thing. In some cases, exchanges like the New York NYSE use a specialist system where a specialist is the sole market maker who makes all the bids and asks that are visible to the market. A specialist process is conducted to ensure that all marketable trades are executed at a fair price and timely manner. How do market makers earn profit? Market makers earn profit through the spread between securities and bids, yada yada. We've talked about market makers making a profit. So we've kind of went through the process here in understanding the market maker and understanding what a market maker is, how a market maker works, how a market maker operates within the system, and kind of how everything works as a whole with a market maker and why they do what they do. So again, market makers are all about risk management. That's their thing. That's why they only offer X amount to buy X amount. They only offer to sell X amount. So keep in mind, when we're in a corrective wave, okay, the market maker has been buying. So they will buy 100, right? And for every 100, they will sell 500. Well, when you get into a market like this, what are they doing? They've amped up the selling. Maybe they're willing to buy 100 again, but then now they're selling 2,000, right? Maybe they're buying 100 again, selling 2,000, right? To the upside. Buying 100 again, selling 2,000. You have to keep that in mind. That's the opposite of what we tend to see over here. Market enticement can happen by market makers stacking on market maker, or stacking on market maker, stacking on market maker, So all these market makers then end up here, and some of these market makers end up probably holding the bag, aka individual market makers, right? And then some of these market makers start exiting, then some start exiting, then some start. And when I say exiting, I mean like they're selling their position, another market maker sells, another market maker sells, market maker sells, and then they offer sell over here. And then the market maker buys. So up here, we could say there's a heavy activity of market makers willing to buy, right? And then over here, there's a heavy activity of market makers willing to sell, right? Price moving up. Then over here, we get a heavy activity of market makers willing to buy, and then we get a small activity of market makers willing to sell, right? So buying, selling, and now we get market makers willing to buy, right? Market makers willing to sell. And then what do we get? We'll probably get market makers again willing to buy, right? So that's why we have to understand the structure. Over here, we got market makers willing to sell. This is why consolidation is key, because you have market makers who have been consolidating and they've been over here buying for all this time, right? And now they have a lot to sell. And they can only sell to you as much as they have. And then after they've sold everything well, not everything, right? They're always selling, buying. After they've sold to you, to a point to where, now a lot of people think, oh, so, deflationary or limited in supply is a positive thing. Well, these deflationary and limited in supply are positive, but they can also have their drawbacks, right? They can only go up so much. There's only so much liquidity. So once you get to a certain point, the market makers are now no longer willing to what? They're not willing to sell to you anymore at these prices, right? So you're probably sitting there like, what do you mean? Well, they're selling, then they're buying. Selling, then they're buying. Selling, then they're buying. Selling, buying. They were able to commit X amount of liquidity here. Price ran up, they sold back down, right? Or they bought back down, sorry. And then price went up, they bought all the way into here, and they created what we call a short squeeze. This is a short squeeze. Price then shot up, right? They're selling. So the market makers that didn't get out of here are now giving themselves a second chance. Then they're buying the move into the move, and then they're selling, and then they're selling at a premium, aka double top, right? See how the move moves up, and then they're buying, selling, buying, selling, buying, selling, buying, selling, and this is how corrective waves work. This is how market makers work. This is how price action works. So with this video, I went pretty deep into this. I really hope a lot of people get something out of this. I put a lot of effort into kind of explaining this. And I think it's really well laid out on my part as far as explaining, the thought process and the reasoning behind the market maker. Market maker has no intention of long-term holding typically. I just want people to understand that. The market maker's intention is to consistently trade the market, because without consistent trading, there's what? There's stagnation. You don't want stagnation in the market. So be very careful about getting into these type of things and just thinking that, institutions are buying and holding. I've said this many times. That's not their intention. Their intention is to buy and then sell, and then buy and then sell. Institutions are traders. That's what they are. Not long-term hodlers. I'm going to put this in my vault and I'm going to keep it to myself, yada, yada. Maybe somebody in Walmart does or whatever, but if they are in this market as an institutional money, their purpose is to buy and sell and provide liquidity and make money on the buy and the sell, not the long-term hodl. So I consistently hear people say, oh, these institutions will hold, yada, yada, so on and so forth. Guys, you got to get that. Look, that's not the mindset at all. This is the market maker. I showed you the definition. I explained to you the definition. I showed you on the chart how that works, all that stuff. I hope this really helped some people out. Until next time, I'll see you later.